This is episode 1119.
One of the things I've seen companies make mistakes time and time again when you go through a cycle of we've got to reduce expenses is you just reduce the headcount and then you expect everyone to do the same amount of work. And it just burns out your good employees and you fail as a company. You're setting up to fail. So really identifying what are the lowest priority stuff that can give. If we're not going to have resourcing to work on things, then we've got to decide what work can we give. And that's where the work units comes in handy, is it should be very apparent to everyone, out of all the work you're doing, here's what's going to give, and being clear and aligned on that.
Hello, everyone. On today's CFO Thought Leader, we explore what it takes to drive mission-driven growth in the SaaS arena. Our guest, Matthew Hardy, has served as CFO for 6 different SaaS companies, navigating markets from fintech to edtech to e-commerce, and now leading finance at Bonterra, a mission-driven software company serving nonprofits and social impact organizations. Along the way, he's mastered the art of balancing private equity expectations with purposeful impact, proving that financial performance and meaningful social outcomes can thrive together. Our talk with CFO Matthew Hardy begins after this.
When it comes to company spend, most finance teams are on defense, reacting to surprise spend, chasing receipts, saying no. But there's a better way. Meet Brex, the AI-powered spend platform that boosts a company's control, earnings, and speed. 99% of customer spend is compliant. 11 million hours saved on expenses and accounting through automation. $681 million plus back to customers in business building rewards. Make every dollar count with Brex.
Hello, Matthew Hardy is with us. Having served as CFO for 6 different SaaS companies, he's leveraged each chapter to solve the many mysteries behind driving strategic growth. And now at Bonterra, it's about social impact through technology. Matt, welcome.
Thank you. Glad to join.
So Matt, as you probably know, we always like to begin by asking to look back and try to share with us some of those maybe pivotal moments that shaped your path to the CFO role. What would you share with us?
Yeah, looking back, my career has evolved very differently than I would have thought when I came out of grad school 25 years ago. So that was before SaaS was SaaS. We used to call it hosted or ASP. And I was working in investment banking. I saw a tech company that we covered that I'm like, they never need to sell new customers again, and they will grow in perpetuity for 10, 15% a year. I'm like, this is the greatest business model for a finance person there is. It was a fintech company that did internet banking and bill pay. So joined that company and was a public company. We were standalone for 5 years. We sold to Intuit, stayed with Intuit for a couple years. And there was really no path to be a CFO there. I was, at a divisional CFO, but there was a CFO at Intuit, and the advice I got was go smaller company and then get the title, and then you can come back to public land. So that's exactly what I did. I went to a small private equity-backed SaaS company. Little did I know that over the next 15 years, private equity and technology would become so intertwined now. And now it's almost unavoidable. I mean, if you look across the landscape, it's very, much smaller amount of public companies, but just tons and tons of PE-backed companies with lots of leverage on them. And so it was really pivotal for me to go get that title. I was very fortunate to work for some excellent investors. Summit Partners was the first firm that I worked with. I actually did a back-to-back stints at Summit portfolio companies, transacted on both of those. And that really sort of set the foundation for the career progression since then. So it was really sort of that first transaction, selling to Intuit, going over to the private equity side, and then the market went crazy on private equity-backed tech companies, and here I am.
So, finance leaders will share stories about the private equity relationship that they have over time. It seems like you saw that as like a corridor to build your career. Am I overstating that?
It wasn't the original intent going in, but I will tell you, it has been fundamental to every opportunity that I've had come up, and it is really critical. I always caution when I hear people are raising money or they've got term sheets out. I'm like, look beyond the terms and really understand the people that you're going to be working for, because everyone looks great when you're first talking with them. Everyone's happy. It's all the happy speak. We had a time at one of my companies where we had a Series B investment come in. Company was not performing nearly as well as anyone had hoped. It was pretty obvious they were just going to get their coupon back. They weren't going to convert to common. We had to make a change at the CEO. I served as interim CEO. We put the company up for sale and transacted it. No way we could have done that without very supportive investors. And they could have been very grouchy. They could have bemoaned, the model didn't pan out. Why didn't it pan out? Go suss out all the variances that you told us about that didn't materialize. They took what they had and they realized that the best path forward was to really get behind the strategic decision to sell the company. And they, at the closing dinner, they would have said, and we're very happy to say we got the best outcome we could have in the situation. It just really was a highlight to me how important it is to have a good relationship with your investors.
Seems like you as well are somewhat versatile. I mean, we mentioned SaaS and technology, but you're in fintech, then you're in ed tech, you're in e-commerce. So you're transitioning across these industries. And it seems like no problem. You were comfortable doing that.
It's interesting, if you would have told me when I started my career that I'd have stints as short as 2.5 years, or as long as 7 or 8 years, I would have thought that's a pretty dodgy career. In fact, my mom, every time we sell a company and I change jobs, she thinks I'm getting laid off or that something cataclysmic has happened. But that's just the nature of private equity. You're probably coming in shortly after the investment. You're probably going to be there 3 or 4 years, and then you're going to transact. I've been fairly agnostic. When I get calls on opportunities, I don't disqual anything based on the space. I will say, as I've gotten older, you recognize so much commonality in vertical SaaS. So from a CFO perspective, the metrics we track, the way we operate the business, the cadence inside your close cycles, especially when it's in private equity-backed companies, is pretty similar. I have found a preference over the last few years to really try to work for companies that I believe in their mission and the impact that they can have. I used to be more enterprise SaaS. I'm much more looking for what does the company do and what's the impact that it's going to have on the world as I get to the tail end of my career.
You might have already hinted at this, but just given the number of chapters that you've had, I'm wondering which CFO stint was maybe the most unexpected or career defining.
That would probably be Telesign. So when I joined Telesign, we had just transacted Live Office, which was a Summit Partners portfolio company. I went over to Telesign, small company. I mean, it was one where I'm coming from big company into it, and all of a sudden I'm at small company Live Office, small company Telesign. You're doing everything. I'm in QuickBooks. I'm doing the journal entries. I'm doing things that I had staff do at Intuit. It was one where we had to build it from the ground up. It was not one where you come in and optimize, but we were able to take it from really a single customer that was generating, almost all of our revenue to a pretty robust business over the 5 or 6 years. A lot of twists and turns in that. I really look at that as cutting my teeth. Now, to prep for that, I worked for a very wonderful CFO when I first went to the company side at Digital Insight. Great mentor who really set me up. And to this day, when people say, who is your mentor, I would reference Liz Murray at Digital Insight. But as far as the company itself, Telesign was really probably the most formative experience that I had.
Just curious, the mindset that you have that might distinguish you from other CFOs. Again, you've stepped into each of these roles and you understand where there's a potential down the road for an exit, whatever it might be. But what is it? Expect the unexpected? What is the mindset that you've learned to adopt over time?
It is that, and there's usually a conversation that takes place before I would accept the role. Just, for instance, when I joined Illuminate, which was an ed tech company, Insight Partners had been in there for a number of years, and it was ripe for a transaction. Knew going in, talked to the investors that we're probably looking at a fairly short window here. Now, you never know. Those windows can close and open unexpectedly, so you've got to be ready. But that one ended up panning out about what we penciled it out. At Telesign, I thought we would transact much earlier than we did. And so it was one where you got to make investments for the long term. And sometimes it's easy to say, hey, we're probably going to transact next year. Let's pull our expenses down. Let's maximize our EBITDA. That can come at, long-term growth. And so I always take the view that you've got to build the best company that you can build. You can't worry about the timing because that's going to be dependent on the market. You look at things like COVID or the financial crisis, and it's like companies could have been doing great, really wouldn't have mattered, when you have existential crises going on like that. So it is expect the unexpected, but if you build the best company and not worry about the exit timing, it seems like that's where I've found the most value created.
You, we all frequently will talk to finance leaders about their communications with the board, and there's always that golden rule: no surprises. You have to learn how to communicate, keep them informed, not overdo it, not underdo it. I just see you with the investors. Early on, you understood what was important to communicate and what perhaps wasn't. As you get 6 months into a new CFO role, you're building that rapport with this a new group of investors. Can you share with us any insights that you might have about that relationship and how you the pattern of communication that you try to achieve?
Yeah, it's critical, and it will vary by investor. So the first couple of companies I did, the investors were minority investors, very different sort of cadence to them. They have board representation, but they're not really going to be in your day-to-day. You're probably going to see them once a quarter at the board meetings. I would always proactively reach out, do a finance update call if there wasn't one formally scheduled. The more recent trend seems to be you've got a very big lead investor with additional investors behind it. And that's really a function of these are all roll-ups. Every private equity-backed company now is a roll-up of multiple companies. And those companies were probably roll-ups of other companies. And so you're going to have multiple PE firms on almost every business that's $300-400 million of revenue or higher. They all have different preferences. There's some that have very systemic ways to report. You fill out an online portal, you're submitting it, they're getting their information that way. Currently, our investors, we do a monthly call that's really kind of a quasi board meeting call, just so we're reviewing financials, we're going through bookings, we're going through retention, we're going through metrics, and that's their preference. So I will say it does vary fairly widely by investor, and that is critical to understand when you take the role, because if you're not prepped and that's not your thing to really be upward managing, you're going to run into a lot of friction that's unnecessary.
Excellent. I want to understand now the opportunity, and we want to I'll ask you about Bonterra and explore this company with you. But I'm wondering, this is a different company again. I mean, it's a different kind of company. Social impact is a big part of its mission. Did you change your path? Would this appeal to you 5 years earlier? Tell us something about the decision-making that brought you here.
That would be, both a personal. I'll give my kind of personal reasons that I came to Bonterra, but I'll also say professionally why I came here. So I worked in ed tech during COVID, and the products that we had were very fundamental to remote learning. Remote learning was still, a challenging environment for everyone, but absent the tools that Illuminate Education had, a lot of the large urban districts that we served would have had trouble meeting the moment on that. It was the first. I come from a family of educators, so my daughter's a kindergarten teacher, my sister's a kindergarten teacher, elementary ed teachers up and down the line. It was the first time I'd worked for a company where they actually knew the products. They actually used the products. My daughter used our products, and they knew what Dad did. And it was so fulfilling to see the impact it was having. And personally, it gave me a lot more satisfaction than selling security software, email archiving, something along those lines. I went to a second Insight Partners portfolio company after we sold Illuminate Education, and it was in the e-commerce space, traditional vertical SaaS. liked it, but I really felt like something was missing. And so when I really thought about, I'm at the tail end of my career, I probably have one or two more exits that I'd like to go through, and then I'll do something that's not CFO related. Bonterra presented itself, and you don't have to believe 100% in our mission to work at Bonterra and love it. It's a lot easier to work at Bonterra and love what you do when you really believe in our mission. And so for me, it was very mission driven. It's also a great opportunity. You know, we've got a good market opportunity. We've got good investors. We're growing in a tough market. And so for me, it was a combination of, it's a good vertical SaaS opportunity, but it also has an impact that I can be proud of.
Nice. Well, that's a good segue for us. Let's find out about this company, Bonterra. What is it about? What are its offerings?
Yeah, so we have, you know, different products, and they do sort of map to the consolidation of this company over time. So it's the people would Google Bonterra and they say, oh, it originated in 2021. That's when our lead investor Apex bought the companies. Vista was holders of a company called Social Solutions. Insight Partners was holders of a company called Every Action. And all those companies came under one umbrella, but the company actually goes back to its core. We have customers that are 20, 25-year-old customers, so a lot of long-standing relationships. We do mission-driven software, you know, purpose-built software for nonprofits. We also have a business that does software for large corporations that want to distribute their funds. So we call it strategic philanthropy. That would be your Fortune 50s, your foundations that want to give funds to nonprofits. How do they do their grant management? How do they process those grants? We do software related to that. Our impact management business is to help nonprofits understand the impact that their funds are having and their initiatives are having. This can be at like the micro level, small nonprofits, but we also have some very large clients that are doing big initiatives with cities and states. They're putting millions of dollars behind their initiatives. The first question they want to know is, what's the impact? I think a lot of philanthropists over the years have spent a lot of money on something, and then you step back and you're like, did anything change? Did we accomplish our goals? Our impact management products will help customers understand what the impact of their initiatives are having. And then we have what we call fundraising and engagement, or F&E, and that's your traditional CRM type software, donor management that any nonprofits, from our small micro nonprofits all the way up to your very large national name recognition ones that you would know, nonprofits that use our fundraising and engagement solutions.
Well, it would be interesting to learn then the type of lens that you have as you talk about, you know, social impact and doing the greatest good. You know, what are the financial metrics that drive your decisions as you try to scale this technology for the greatest good?
Yeah, it's a good question. So we are out of what we would term like the impact funds from our investors. So most private equity funds have impact or social good funds, and we are part of that population. That said, it's not like we get any relief, like they don't expect a good return or they don't track us the same way that they would track any sort of vertical SaaS company. So we do track all the same metrics you would typically see in your vertical SaaS companies, your new bookings, your installed base bookings, your gross retention, net retention, your margins, your EBITDA. We track all that. We also, though, are trying to make sure our customers succeed. I believe this for any product, but particularly with ours. If your customers in this day and age aren't finding significant value, if they aren't realizing that value and feeling it on a daily basis, you're not going to last long with those customers. Gone are the days where people just sign up for platforms and use them, you know, cursory for years and years and just keep paying them. And so we need to make sure we're enabling our customers to see their metrics and that they're achieving their missions, whether that's fundraising goals or the impacts that they're having on their communities in which they're serving, or whether it's large corporations that want to make sure employees are engaged with their time and money and they're matching grants and giving it to the causes that their employees feel strongly about.
Wondering how you go about forecasting and managing fiscal risk in those sectors that are vulnerable to fundraising volatility, let's say.
Yeah. It's a good question, very timely question. With the new administration when they came in, really, hit the ground running on eliminating USAID, and a lot of our clients are impacted by that. A lot of our nonprofits are reliant on government grants. For us, we've got to meet the moment and help them understand, let us help you diversify your fundraising. So we've got tools that can help you so that you're not so reliant on government grants. But it kind of reminded me when COVID first hit. I was with a customer experience company. First thing we did was go customer by customer, who's impacted, what do we think their impact's going to be, what kind of offerings can we go? And we went and did promotional pricing to them to try to give them short-term relief in exchange for long-term benefits. We think about this the same way. We want to make sure our customers succeed. And if we have to be flexible on that, even if it's going to, be a little different profile of revenue than what we had anticipated when we set the year, we got to keep these customers and keep them happy and keep them fulfilling their mission. We track our metrics the same way as we would otherwise, but we do have additional metrics in a year like this where we say, hey, if we lost a customer because they used to have 900 employees, their grant got cut, they have 2 employees, and so they've churned. We do have what we call our pro forma metrics that try to isolate that so we can see what the underlying business is doing. But it has been a challenging year just from a macro environment. We're seeing that across both the corporate side as well as the government grants impact.
When it comes to, let's say, investment in innovation, investment in innovative areas of the business, what role do you play? What role does finance leadership play?
Yeah, a lot of it is on resource allocation. And so, identifying where do we have potential investments? Do we need to invest more in demand gen and sales and marketing to drive top of funnel so that we can get our bookings up? Do we need to put more dollars in our product? A lot of that's driven by what's driving our churn. We look at our customers. Is it pricing? Is it packaging? Or is it market fit? And where do we need to put resources behind that to remediate that? We definitely look at, the ROI, and you've got to have a kind of a long-term view on that. In a SaaS business, the beauty of SaaS, it's not going to fall off a cliff overnight. The bane of SaaS is everything we do today starts to stack, but that impact's probably not going to be felt for another 12 to 18 months. And so making sure you've got alignment on, here are the resources that we're dedicated, here's what we're funding incrementally to what we normally would, here's what success looks like. Get in alignment from the board so that when you show up and they are like, well, you're investing, but bookings aren't growing. And got to make sure that up front you're saying, we don't anticipate bookings to grow for the next 12 months, but we're making a strategic bet on this. And that only can work if they have confidence that we're looking at those ROIs, that we're understanding the assumptions behind them, that we're partnering with product, tight partnerships with product and with sales and marketing to know, if we give you this dollar, how's it being spent? What do you expect to get back from it? And budgets are always tight. Every 25 years I've been doing budgets, they've always been tight. I don't think I've seen tighter budgets, and that's both from a customer and internal side, than I have in the last 2 years. And so every dollar is critical. Eliminating waste, we're doing a lot of internal initiatives around AI to try to get more efficient. A lot of that just comes from finance, making sure that we've got the right dollars in the right places that will maximize long-term value.
Are you able to sort of trace ROI, not just to efficiency and eliminating waste, but also to actual social impact? Dollars we spent here had the biggest impact. I mean, is that part of the equation, or is that a little beyond your?
No, it is. Attribution's always hard. It's always tough to say a dollar spent here had this impact, especially if you're raising the level of something. And so we look at, we would like to believe, and our products will show you that we can help customers increase their fundraising efficacy. We invest in the product. We've got some very cool products that are just on the cusp of coming out that are going to help customers in ways that probably no one would have been thinking about 3 or 4 years ago. And we do track that. How much are you raising? And now you've deployed this functionality. How much are you raising now? That's what our customer success team is doing. We have an overarching goal as a company to get to 3% of GDP by 2033, meaning that right now, charitable contributions hover right around 2.5% of GDP. It's been very flat for decades. We think that it can get to 3%, but it's got to be a concerted effort, and people have to do things differently than the way they've been doing it before. That's what we're trying to enable, is to unlock that so our customers are able to accomplish their missions. Those are the metrics that if we exit and we look back, if we've helped our customers get to those metrics, we'll feel like we had a successful run.
I want to touch on AI with you. I'm wondering if Bonterra is adding AI-driven capabilities in fundraising or CSR platforms.
Yeah, absolutely. I think if any SaaS company isn't answering that question, yes, they're going to be out of business pretty quickly. I'm old enough to remember when we went from license and maintenance software into SaaS. That was a pretty long tail that we had. That was like almost a 10-year cycle where you tried to wean off of that big pop of revenue that you got into a SaaS and license-based model. This momentum, meaning we've got SaaS offerings that are traditionally license-based offerings moving to AI. I mean, even things like, how do you price AI? Are you pricing it on a per query or per, transaction, or are you pricing it based on a seat license? Those things are changing very rapidly, and absolutely we are doing a lot along those dimensions. I will say, look in the next couple months, and you'll see a lot of exciting stuff coming out for Bonterra. We're doing that from both a product-facing perspective. We also use and utilize AI internally. It used to be kind of rule of 40 was what you aspire to. Hearing a lot of investors talk about 40% EBITDA margins, rule of 50, rule of 60 companies. The only way you get there is by changing the way that you do your work. And you got to have tools to do that. We're building a lot of agents internally that take some of our work units. So we are deploying AI both internally and product facing.
How do you evaluate the business case for doing that, for integrating AI into part of the business? How do you evaluate those business cases? What are you looking at?
Yeah, so we're pretty at Bonterra. If you ask someone what they do, they will have their work units defined. Every role in our company has work units defined. So basically, how do you spend your time? What are your major components of your day? When I first got to Bonterra, it's the first thing I did was, let me go through each of my employees. What are your work units? And look at the ones that they're just perfect to be agentified. You look at it and you're like, this is a repetitive task that does not require a lot of independent thinking, but you're spending 30 or 40% of your time on it because your tools are 10 years old. You're doing it the same way you did it on an Excel spreadsheet 10 years ago. So I start with, where's the biggest pot of money that we can get out? What are your work units that are taking the most time that I can take out with an agent that costs not a lot of resources to write, and then can do an unlimited amount of work across all of that role. We've just recently deployed an agent in our billing cycles, in our collection cycles, and they're starting to handle up to 30% of deflection on work that used to come in, or tickets that used to have come in. Eventually that translates into dollars. Usually it means that as we scale, we don't need to add headcount, or as we lose employees, we can continue to do the same level of output without adding more heads. But eventually that's going to yield companies that are getting into those 40, 50% EBITDA margin companies, which if you would have told me that 5 years ago, I would have said, I just don't see a path there, but I do see a path via AI.
When you think of Bonterra's mission, what excites you most about AI?
The way I've looked at our offerings that are coming out is, if you look at a lot of our nonprofits that we serve, they are stretched right now. Budgets are cut, employees and staff are burnt out. And that means that they can't be as effective at their mission as they want to be. We've got products coming out that are going to be 10x, 20x, 100x multipliers, like a force multiplier on what our clients can do. And there's always a lot of hype when something's new like AI. I know you probably hear any CFO would come on and tell you that the same thing. We're going to have products in market that are going to really start to have an impact immediately on how our customers do their business. Makes their life easier, but it also makes them a lot more effective at what they're doing. And if we can add 20-30% more funding to these clients of ours, that's a 20-30% more impact that they can have on their communities, on their missions. And that's really what drives the excitement for me.
Have you found yourself dedicating any time to some of the, let's say, governance issues or challenges that AI might pose across the organization?
Absolutely.
Yeah.
Yeah, one of, just a simple use case. We looked at work units and said our talent acquisition team is doing a lot of resume screening. In this market, it's kind of a hiring market right now. You open up a role for a financial analyst, you're going to get thousands of resumes in. There's always been resume screening tools that have been out there. That's something that's not new. We wanted to write an agent that would help take some of that work unit away from talent acquisition. But you get into it and all of a sudden you're like, how are we sure we're not having any bias manifest in the system? Are we coding it correctly so there's not bias in there? And we had to take a step back and say, I don't know that we're ready to write that work unit yet. We have an AI governance committee. It consists of a cross-functional group of people that, whether it's InfoSec or legal or human resources, they are all involved in those decisions because we don't want to unleash, unintended consequences. And so we absolutely have a mind on how this impacts employees, how it impacts the work that we're doing, and making sure we're doing it in a way that's smart.
Well, great insights there for us. Thank you so much. We're up to what we like to refer to as our finance strategic moment. And this is where we ask you just to share one moment in time, one career chapter or one of your CFO chapters that revealed something. You had a moment of insight. Anything come to mind?
Yeah, I as I think about it, a lot of excitement around transactions I've done. Those are always kind of the flashy things, especially when you're selling the company. But if I kind of look back on where did we create value, where can I say finance actually impacted the enterprise value when the company exited? I would, reference one of my early days at Digital Insight. When I got there, it was early days of SaaS, and so there was still a lot of nuance around how do you organize a business. We had GM structures over products. We had a services business that we tried to manage a P&L to. So we look and say, what are your services margins? And then we had this beautiful base of recurring revenue. And when you really peel it back, that's what's going to drive value, is that recurring revenue that we get. How do we maximize that recurring revenue? We found, as we looked at it and we were trying to analyze all of the margins by product and where all the resources, put aside the friction that creates inside a company, because there is a lot around, we're going to discount to a customer. Is your product taking the discount, or is my product taking the discount? And a lot of internal friction that way. When we looked at it, we saw that customers who were using the most products, we kind of had a between 4 and 5 of our products. If you were using that, your likelihood for churn was down to about 0. It's just such an entrenched product at that point. We also found that if you didn't use our implementation services and training well, you had a much higher likelihood of churning in year 1. We took that and we said, well, if we're trying to maximize ARR, why are we worried about services revenue? Why aren't we just bundling that in, making it mandatory that everyone gets training and implementation, because it will make up for the cost when they don't churn. And we can build in a cost so that when they come up for renewal, they're not line iteming out this one-time implementation fee that we did. So we looked at it from both an implementation and service perspective. We also looked at the way the customers bought. We like to look at it on a GM by product basis. That's not how our customers were buying it. They viewed us as, this is your total offering. We recommended, and ultimately the company eliminated product line P&Ls, which can seem counterintuitive. A lot of companies spend a lot of time looking at it, but if that's not how your customers buy and that's not how you're organized internally, it's much more of a spreadsheet exercise that's driving it's going to be counterproductive for the organization. We saw our revenue growth go up from about 12% a year to almost 16% a year after we made those changes. Higher retention, better bookings, customers, higher retention in year 1. And that was one where when we exited, I really looked back and said, I think that was a pivotal moment for the company. It changed the way it was organized, it was structured, it was a data-driven analysis, and it had the intended effect that we thought it would. So proud moment for the finance team.
We're up to our mentoring round, where we're going to ask you to look back. And, you shared some that first transition after Intuit into a sort of a CFO opportunity. That's you worked some magic there over those few years there, because again, what we always hear is it's hard to become a CFO if you're not already one. And actually, the rest of your career plays that out. CFO opportunities found you, but that first one was clearly perhaps the most transitionary for you, in my way of thinking. And here's my question: you arrived finally. You're the CFO, okay, and then you realized, wait a minute, I didn't realize this was part of the role. What is the advice, if you could go back in time as you stepped into that role for the first time? What is it that you would tell yourself? What is it that you didn't know?
Yeah, a couple things that I totally underestimated was there's no backstop for you. I was very senior level finance at Intuit. Felt like, look, I have visibility. I've been, side by side with a public company CFO for 5 years, and now we got bought and we're part of this bigger company. I've seen it all. I understand what everyone's doing. I can do this job. And to your point, that's the biggest challenge you have when you're at that SVP finance level is how do I convince a board to take a chance on someone who doesn't have the CFO title? And just as a byproduct, I would say in my career, when I've hired people who are stretching into the role, I've always had the best success with. It's sometimes you kind of go, let's get someone who's been in the role for 10, 15 years. A lot of times they're just not as hungry at that point. And so I think that there's a good path there. But for me, I was like, okay, I know I can do this role. I've been quasi functioning in this role for a few years now. I went to a smaller company and I thought this is a slam dunk. There's no backstop. The CEO is looking at you to make financial decisions and calls. You're making the ultimate call on, accounting judgments and audit related stuff. And that can be unnerving all of a sudden, because it used to be I'm recommending the CFO at Intuit or at Digital Insights probably going to take my recommendation. But if something goes sideways on that, there's a buffer there. Now I'm just 100% exposed. And so I had to really feel confident in myself, where I knew what I knew and I was confident in it. And I didn't want to second guess myself, because I find that indecision is going to be worse than a bad decision that you can course correct down the road. So what I would tell myself is you trust your gut, go with it. You've got the experience, you've got the knowledge, you've seen these things play out. Don't be afraid to speak up, take a controversial position where you need to, but be assertive in your views. I was very fortunate. I worked for Nick Mehta, who's now the CEO of Gainsight, in my first CFO role. And it was great having a very supportive CEO who was kind of on that same journey with me. They were patient. It was one where I'm like, yeah, I thought I knew everything, but now I'm in a private equity-backed company. We're not filing 10Ks and 10Qs. We're reporting out to our investors, and it's a different cadence. And there was a learning curve on that. And so the other thing I would say is, be open where you've got struggles. It doesn't do any good to pretend like you know something if you don't. If you don't know something, say, hey, I haven't encountered that before. Let me give it some thought. Let me talk to some mentors that I have. Now it might be, let me talk to ChatGPT, but let me go and do some research and come back to you. You don't have to feel like you have to know everything right off the bat. There's still a learning curve. I still learn things in every company I go to. I tell my family this all the time. As much as I've seen, I've never had a role where I haven't encountered something where I step back and think, never seen that before. That's a new one on me. So it's okay to always be learning.
I just want to point out that your earliest chapter, I could see undergrad, you studied accounting. So, you were already pretty focused. You go on for an MBA a few years after you get your bachelor's. You go to Wharton. Would you have done it differently then? Would you have waited to go to business school, or was that the right time? Any thoughts as you look back?
There was about a 5-year gap, and it was pretty traditional path at the time. I will tell you, I have a son who's working in investment banking right now, so I've kind of watched his journey over the last few years as he graduated college and moved into it. The world is so different now. I don't think I would have taken the path that I took if that was me starting out today. So, and I say that for a couple reasons. One is, the thought of, I've got to work 5 years to go to MBA school and then my career starting, that puts a lot of people in their late 20s, early 30s where you're starting. I think you can have an impact and create a resume that can get around that. I was a career switcher. So you're right. I studied accounting, but I really wanted to be more broad, more finance. I needed to get an MBA to do that. If I had had a finance undergrad and had worked in it for an investment bank, I probably would have not gone the path that I did. But I don't regret it at all. I feel so fortunate to have had the opportunities I have. And I do kind of trace it back when I went to Wharton. That was kind of a big break for me to get into Wharton and to go there. And it set me up. I don't live off of that today. I don't get a lot of calls that note that, hey, you're a Wharton MBA, but it still comes up all the time. My network's a good network because of it. And so I absolutely am glad the path I took. Just don't know if I would recommend it to someone starting out today.
We always like to reflect a little on the personal side. Is there something maybe your colleagues might not know about you, something from an earlier chapter, something business pursuit, something entrepreneurial, I don't know, or just a interest that you have?
Yeah, all good questions. I'll give you a personal one that people usually don't think of that they find funny. I'm a reality TV Bravo watcher. So we're empty nesters now. My wife and I have 2 adult kids. And after my son went to college 6-7 years ago, I'm like, man, we used to talk about the kids all the time. Now the kids are a little bit less front and center. We don't have as much in common anymore. So I kind of adapted and started watching the shows that she was watching. So if you have any questions about Real Housewives or Summer House or any of those, I can be your guy for that. So definitely a little nuance. I will say before I went to business school, I did do an entrepreneurial venture. I thought this is the right time to do this. I wanted to pad my resume to apply to MBA school. You want to kind of stick out and look unique. But we did a product that we tried to partner with Delta Airlines on, that when you flew into a city, when you were walking down the jetway, you would pull it out and say, I'm going to Atlanta. Here's a 12-page kind of advertorial that shows what's going on in Atlanta. It's supported by advertisements. In this day and age, kids wouldn't even understand what I'm saying there because it's so antiquated. You've got everything on your phone. But at the time, it kind of sounded cool. It didn't end up, we ended up just giving it back to Delta. We raised some Series A money that I thought would last us for years, that lasted us 12 months. It was, not a great outcome, but it was a great learning experience. And it's one that I look back on. If you haven't sweated payroll as a entrepreneur, I don't think you've ever really lived as a business person. When you've got to cover your net payroll one week and then try to cover your payroll taxes the next week, things start to be real. And I'm very glad that I cut my teeth in that type of an environment.
Great. Thank you for that. Wondering if along the way, there was a book that influenced your thinking, or would you just have a book you'd like to recommend? Doesn't have to be a business book.
Yeah. So No Rules is one a lot of people have read. It's Reed Hastings' book on Netflix. I think Netflix is a wonderful story. Lots to learn from that, but they have a lot of insights that I still apply today. I'll just give you, an example. Their view on talent is they looked and they said, our top engineers are writing 10x the code or 10x as productive as our average engineer. Why wouldn't we pay them 10 times as much if we had to? Now, luckily you don't have to pay your employees 10 times as much. But the point being is, let's get the best employees that we can get, even if it means we're going to go over market, because that's a lot better. That having 5 A players is a lot better than having 15 B players. And I still use that both for my own function as well as the company today. So I think it's a good book, No Rules. I also like, reading anything on WeWork and Adam Newman. I found that whole saga very fascinating, both because of the culture and investors, and I've lived and breathed that and see the excitement people get around funding, even when the business model can be a bit tenuous. And so any of the books on the demise of WeWork I found pretty interesting.
Great selections for us. Thank you. We are up to our final question, Matthew, where we're going to ask you to look forward finally. And what we're interested in is your priorities for the coming 12 months as a finance leader. What would those be? Yeah,
we're getting pressed, and I would probably guess every private equity-backed tech company is getting pressed on how profitable you're going to be. So right now, bookings are probably down across every SaaS company that I know, every portfolio company that I know. And so the immediate focus is we've got to put resources behind what's going to drive growth next year. And so that means product, that means sales and marketing. Where's that dollars going to come from? We can't just drop our EBITDA margin. We've got to probably increase our EBITDA margin. So a lot of it is identifying where we've got what I would call fake work units, work that people are doing, but just doesn't add value. One of the things I've seen companies make mistakes time and time again when you go through a cycle of we've got to reduce expenses is you just reduce the headcount and then you expect everyone to do the same amount of work. And it just burns out your good employees and you fail as a company. You're setting up to fail. So really identifying what are the lowest priority stuff that can give. If we're not going to have resourcing to work on things, then we've got to decide what work can we give. And that's where the work units comes in handy, is it should be very apparent to everyone, out of all the work you're doing, here's what's going to give, and being clear and aligned on that. We're just about to start our annual planning process. It's a not so fun time for anyone in the company, but certainly for finance also. We're going to try to do as much zero-based budgeting as we can. Companies say that all the time. They never do it. We're really at the point where we've got to fundamentally relook at, if we were starting a company today, what would it look like? Because there's companies out there that started and have 30 people that are doing $100 million in revenue within 12 months because they've got good product market fit. It can be done. You can't just rely on the fact that this is the way we've always done it, or this is the team I inherited. We've got to look like a young, fresh startup company that's cutting edge, or we're just going to get eaten by those companies.
Matthew Hardy, thank you for joining us on CFO Thought Leader.
My pleasure.